In this video, I'll be going over my thoughts on the general market, including some analysis of recent breakouts failing. So here's the SPY chart, the Spider 500. The SPY has consistently been marching into new ground since the 27th of June, about a month now. Although over the past month, breakout trading has not been so fruitful. The majority of setups failing, or the setups work, they break out, and then they fail, or they break out and they don't make much meaningful movement after the breakout. So breakout trading has been pretty difficult over the past month, even though the SPY has been marching into new high ground. And the reason for that is because the Russell 2000 hasn't been performing as well as it should be. Russell 2000 is a great kind of indicator of broad market participation. And as you can see, this thing is nowhere near all-time high. So there's still a lot of room to be had in terms of broad market participation, and setting up a real proper, quote unquote, easy dollar environment, because we're definitely not in it right now. But if we go back to the SPY, the thing is with this this rally into new high ground, everything seemed nice and dandy, but this whole time it was actually pretty probable that a strong retracement like this was going to come. And I'll tell you the reasons why now. Like I was saying before, with breakout trading not working so well, stocks breaking out to new highs, then fizzling out, or stocks setting up and then fizzling out before breaking out, is a pretty good indicator, pretty good pre-indicator that the market might roll over soon. You know, new setups not working means that the next wave of stocks that might move hard aren't going to move hard. You know, they're going to fail and they're going to retrace. And then another factor as well is the broad market participation, like I was saying with the Russell 2000. And then the third factor is the historical probability of pullback based off of the rally from a bottom. So if we go from the bottom of this bear market and then we go to, we'll just go to the high, you know, this was a 32% advance in the S&P 500 in under 4 months, with no real meaningful pullbacks. We had this pullback, you know, 3%. We had this pullback, 2%. No meaningful pullbacks of, you know, around 5%. So I think here it's probable that we get a pullback up to 5%, you know, maybe pull back a little further or consolidate for a bit. But this was probable just based on how hard the market had ran up without a strong pullback, how recent breakout trading was going over this period of time, and how broad market participation wasn't really improving too well, as you could see with the Russell 2000 not progressing really. And one thing I'd like to go over as well is an Excel sheet I do to weekly, here we are, sorry, to weekly kind of analyze the market and see how many stocks are, say, over their 200-day average, and you know, which market caps and all that. And as we can see, we have regressed in terms of how many stocks are above their moving averages quite a lot. So here, you know, we're at, let's just go for the NYSE/NASDAQ stocks, no ETFs, above their 200-day moving average. We were at almost 2,700, and then boom, 1 week later, we're at, you know, 2,200 about. So it's a very strong decline. But if I go back up here to about 630, that's where we were on 630, right? We had about the same numbers of, you know, 2,200 around, 1350 down here, 1316, you get my point. We had very similar numbers in terms of broad market participation. But the negative thing about this is that, so this is showing wavering broad market participation. Up here, this was just kind of contrarian hated rally because the rally hadn't been accepted yet. Here is the retracement from the rally being declined, there's heavy voting power, heavy negative voting power, if you will, on this retracement. So back here is when those previous numbers, or those numbers were similar to previous, and that was a breakout to all-time high. So, broad market participation wasn't too good, but that's all right because it's a rally. It's proving itself. It's showing that even though voting power isn't good, um, it doesn't need to be good because the market has shown we're breaking out to all-time high. We're rallying strong. Here, we have heavy voting power on a decline with, large volume as well. Which is very negative. It could point to a further decline, like I was saying, of up to 5% or so, instead of, just a little 3% decline like we have so far. But that's about all I have for my analysis on the general market. I hope you enjoyed my video. If you found value, please like and subscribe. And you can check out my Twitter at, or X, at Conrad Trading. Thank you so much.